Training artificial intelligence and running the massive data centers that house it requires a staggering 24/7 supply of electricity. To meet that demand, investors have poured capital into tech giants, but they've largely overlooked the physical utility companies keeping those servers online. Take Vistra Corp. They recently reported their first quarter results for 2026, swinging from a $250 million loss the previous year to a massive $1.029 billion net income. This chart shows their adjusted EBITDA, a measure of core operating profit, spiking to $1.49 billion. That is a record high for any first quarter in the company's history. But making that kind of money in the power generation business is exceptionally difficult. Building and maintaining the physical infrastructure required to keep the lights on is incredibly expensive. Right now, Vistra carries over $19 billion in debt just to maintain its current plants and build out new capacity. Then there is the weather. Utility companies are physically exposed to the elements. A single severe winter storm or an extended summer heat wave can freeze pipes, melt components, and force plants offline, costing operators millions of dollars in a matter of hours. So how does a business burdened by $19 billion in debt and constant exposure to extreme weather project up to $4.7 billion in free cash flow for the year? The answer lies in how they engineered their business to handle risk. Vistra avoids the massive swings of the energy market by splitting its business into two interconnected halves. Think of them as a massive factory and a giant grocery store. The factory is their generation side. They own power plants, nuclear, natural gas, and batteries, and sell the electricity they produce into the wholesale market. This is an open auction where power goes to the highest bidder. The store is their retail side. Through brands like TXU Energy, Vistra buys electricity and sells it directly to nearly 5 million households and businesses. These customers pay a predictable, steady monthly rate. This structure creates an integrated hedge. Look at this flowchart showing what happens when a heat wave hits and wholesale electricity prices spike. The retail store suddenly has to pay much more for power, squeezing its margins. But simultaneously, profits on the factory side shoot up because they are selling their power at a huge premium, easily covering the store's losses. If energy prices crash, the factory makes less money in the open market, but the store gets to buy its inventory for cheap, expanding the profit margin they keep from those stable monthly customer bills. By owning both sides of the transaction, Vistra effectively sells power to itself. They run an integrated risk engine that neutralizes the daily chaos of the grid to lock in steady, reliable cash. To keep this integrated hedge functioning, Vistra relies on two completely different types of power plants. The first is their premium product, a massive nuclear fleet. Following their merger with Energy Harbor, Vistra is now the second largest competitive nuclear owner in the United States. Nuclear power runs constantly and produces zero carbon emissions. Tech giants need exactly that kind of reliable baseload power to hit their climate goals without turning off their data centers. In 2026, Vistra signed a long-term deal with Meta for roughly 2,600 megawatts of nuclear capacity, securing guaranteed cash flow for the next 2 decades. If nuclear is the steady baseline, natural gas is the emergency backup. Vistra operates a massive fleet of gas plants, which they are expanding with the pending 5.5 gigawatt Cogentrix acquisition. These natural gas facilities are dispatchable, meaning they can be fired up almost instantly when a massive storm hits and the larger grid begins to fail. Because these gas plants are essential for grid survival, operators pay Vistra capacity payments. This functions like a lucrative retainer fee, paying Vistra just to keep the plants fully operational and ready to fire during peak grid stress. Vistra requires both engines. The clean nuclear assets secure the high-valuation, long-term tech contracts, while the natural gas fleet provides the raw physical muscle required to survive and profit from severe weather volatility. Operating this self-hedging dual-engine system generates significantly more cash than Vistra needs just to maintain its equipment. This chart shows management aggressively cannibalizing their own stock. Since November 2021, Vistra repurchased $6.3 billion of shares, reducing their outstanding count by 30%. With fewer owners, profit is split less ways, rapidly inflating earnings per share and multiplying the remaining stock's value. There are, however, structural risks to this model. Vistra operates primarily in competitive markets like PJM in the Northeast and ERCOT in Texas. Both grids face intense regulatory scrutiny, and any sudden changes to market design or new taxes on nuclear generation could severely compress Vistra's margins. The stock is also trading at a premium multiple. If artificial intelligence growth stalls, limiting the need for new data centers, or if a string of unusually mild weather prevents wholesale energy prices from spiking, the company's massive growth rate could flatten out. Despite those risks, Vistra has capitalized on a very real shift in energy infrastructure. They combined highly reliable power generation with a balanced retail business to create a financial machine that converts physical grid stress directly into profit. This video and the discussion herein are for informational purposes only and do not constitute financial advice. Always remember to do your own due diligence and consult a professional